Preparing for a FP&A at Procter Gamble interview, you've reached Candy Mentor and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a company like P&G? FP&A connects financial information with operating decisions. At P&G, I would help brand and business leaders understand performance, build forecasts, evaluate investments, and allocate resources across products, markets, and capabilities. The role is not simply reporting historical numbers, it is explaining what changed, why it changed, and what management should do next. Strong FP&A combines analytical accuracy with commercial judgment, allowing leaders to balance growth, profitability, productivity, and long-term brand health. While answering, focus on planning, forecasting, performance analysis, resource allocation, business partnering, and translating financial results into actions across brands, categories, markets, and functions. Question 2. Why do you want to work in FP&A at Procter & Gamble? I am attracted to P&G because its brands operate at enormous scale, yet performance still depends on detailed decisions about consumers, pricing, innovation, promotions, and execution. FP&A would let me combine accounting discipline with commercial analysis and work closely with marketing, sales, supply chain, and operations. I also value P&G's reputation for developing talent and emphasizing ownership. I would be excited to turn data into recommendations that improve profitable growth and strengthen brand performance. Make sure to cover P&G's portfolio of trusted brands, global scale, consumer focus, disciplined execution, cross-functional exposure, and your interest in connecting financial analysis with commercial decisions. Question 3. Walk me through how you would build an annual operating plan. I would begin with the prior year actuals and establish a clean baseline by brand, market, customer, and cost center. Next, I would gather assumptions for volume, pricing, mix, distribution, commodity costs, foreign exchange, advertising, promotions, headcount, and productivity. I would challenge assumptions with business partners, model base and downside cases, and reconcile the plan to strategic objectives. Finally, I would document ownership, secure approvals, and create monthly metrics to track delivery against the plan. In your answer, talk about historical baselines, strategic assumptions, volume, price, mix, cost drivers, investments, stakeholder alignment, scenario analysis, review cycles, and final governance. Question 4. How do you prepare a monthly forecast or latest estimate? I start by loading validated actuals and comparing them with the existing forecast. Then I update the remaining periods using operational drivers such as shipments, consumption, pricing, promotional calendars, manufacturing costs, headcount, and currency rates. I speak with functional owners to test assumptions rather than accepting unsupported estimates. I quantify risks and opportunities, prepare a bridge from the prior forecast, and clearly explain what changed, the confidence level, and any actions required. Be sure to mention actuals to date, run rate analysis, updated operational drivers, stakeholder input, risks and opportunities, variance bridges, documented assumptions, and a clear management recommendation. Question 5. How would you analyze a significant unfavorable variance to budget? I would first confirm that the variance is real by checking postings, timing, accruals, and reporting mappings. Then I would decompose it into volume, price, mix, foreign exchange, input costs, promotions, productivity, and one-time items. I would meet the relevant business owners to understand the operational cause and determine whether the issue is temporary or structural. Finally, I would update the forecast, identify corrective actions, and communicate the financial impact without hiding unfavorable information. Focus on validating the data, separating timing from structural issues, decomposing price, volume, mix, and cost drivers, identifying controllable actions, and communicating both root cause and forecast implications. Question 6. Explain price volume mix analysis and how you would use it. Price volume mix analysis explains revenue change beyond a simple year-over-year comparison. Volume measures units or consumption growth, price captures changes in realized selling prices, and mix reflects the shift among products, channels, customers, or markets. I would reconcile the bridge to reported revenue, define the methodology consistently, and investigate interaction effects where appropriate. At P&G, the result could show whether growth came from genuine demand, pricing, premiumization, or an unfavorable shift toward lower-value products. In your answer, define each component, distinguish reported sales movement from underlying business drivers, address interaction effects, and connect the analysis to pricing, portfolio, and commercial decisions. Question 7. What is the difference between gross margin and operating margin? Gross margin is gross profit divided by revenue, where gross profit equals revenue less cost of goods sold. It reflects product economics, including pricing, volume, mix, commodities, manufacturing, freight, and productivity. Operating margin goes further by subtracting operating expenses such as marketing, research, selling, and administrative costs. I would use both measures because a business can improve gross margin through pricing but still miss operating profit if advertising, overhead, or innovation spending rises disproportionately. Make sure to cover revenue, cost of goods sold, gross profit, operating expenses, interpretation, and how changes in pricing, commodities, productivity, marketing, and overhead affect each margin. Question 8. How would you evaluate a proposed marketing or brand investment? I would assess the investment against its strategic objective, expected consumer response, and incremental economics. I would estimate incremental volume, price, gross profit, marketing cost, trade support, and any cannibalization within the portfolio. Because brand effects may extend beyond one period, I would model both near-term payback and longer-term scenarios. I would compare the proposal with alternative uses of funds, identify key assumptions, and recommend approval only if the expected return and strategic value justify the risk. While answering, focus on strategic rationale, incremental revenue and profit, consumer reach, timing, cannibalization, attribution challenges, scenario analysis, payback, and long-term brand considerations. Question 9. A P&G brand is losing market share but remains profitable. What would you analyze? I would first distinguish whether the share loss reflects a weak category, competitor strength, distribution gaps, pricing, promotion, or declining consumer relevance. I would analyze volume, price, mix, household penetration, repeat rates, retailer performance, innovation, advertising effectiveness, and contribution margin. Profitability matters, but I would test whether it is being protected by underinvestment or temporary pricing. I would then build scenarios for reinvestment, portfolio changes, or productivity and recommend actions based on sustainable, profitable growth. Be sure to mention market growth, competitors, consumer behavior, distribution, pricing, innovation, promotion, product mix, brand investment, profitability quality, and actions supported by evidence. Question 10. How would foreign exchange affect P&G's forecast and reported results? Foreign exchange can affect transaction costs, translated revenue and profit, and the comparability of reported results. I would identify each market's currency exposure, apply approved forecast rates, and separate operational performance from translation impact. I would also consider hedging and the timing of rate changes, while avoiding the assumption that hedging eliminates every economic effect. Presenting both reported and constant currency views would help management understand whether volume, pricing, or execution improved independently of currency movements. In your answer, cover transaction and translation effects, local currency performance, forecast rates, hedging, geographic exposure, constant currency analysis, and how management should interpret reported results. Question 11. How would rising commodity costs influence your analysis? I would quantify the exposure by commodity, product, region, and timing, then assess whether costs flow through inventory before reaching the income statement. Next, I would model pricing, productivity, sourcing, formulation, mix, and promotional actions that could offset the pressure. I would prepare sensitivities around commodity prices and foreign exchange and explain the expected gross margin impact by quarter. The key is linking the cost increase to practical mitigation rather than presenting it as an isolated variance. Focus on exposure by material, timing, inventory effects, supplier contracts, pricing, productivity, reformulation, mix, sensitivity analysis, and the difference between gross margin pressure and recovery actions. Question 12. What financial metrics would you monitor for a consumer products business? I would monitor organic sales growth, volume, pricing, mix, market share, gross margin, operating margin, advertising effectiveness, working capital, operating cash flow, and productivity. I would avoid viewing any metric in isolation. Strong pricing may hurt volume and margin expansion may reflect underinvestment. For each brand or market, I would compare actual performance with plan, prior year, and relevant external benchmarks. That combination provides a balanced view of growth quality, profitability, liquidity, and future competitiveness. Make sure to cover organic sales growth, volume, pricing, market share, gross and operating margin, advertising efficiency, working capital, cash flow, productivity, and return on investment. Question 13. How would you forecast sales for a P&G product? I would combine a statistical baseline with commercial intelligence. The baseline would use historical shipments or consumption, seasonality, trend, distribution, price, promotions, and product lifecycle. I would then incorporate retailer inventory, planned innovation, competitive activity, market growth, and known customer events. I would reconcile shipments with consumer takeaway where possible, because channel inventory can distort performance. Finally, I would test the forecast with sales and marketing partners, document assumptions, and update it as leading indicators change. In your answer, discuss historical trends, consumption and shipments, distribution, seasonality, pricing, promotions, innovation, retailer inventory, market data, and cross-functional challenge of assumptions. Question 14. Describe a time you found an error in financial reporting. In one reporting cycle, I noticed an expense trend that did not align with the underlying activity. I traced the variance to a duplicated accrual created during a system upload, confirmed it with the accounting owner, and assessed its effect on the close and forecast. We corrected the entry before management reporting, documented the issue, and added a duplicate check control to the process. The experience reinforced that curiosity, reconciliation, and early escalation protect both accuracy and credibility. While answering, use a clear situation action result structure, explain how you validated the issue, assessed materiality, corrected the reporting, communicated transparently, and improved the process afterward. Question 15. How do you ensure accuracy when working with large datasets? I establish a controlled workflow before analyzing the data. I confirm the source, period, currency, dimensions, definitions, and completeness, then reconcile totals to the general ledger or approved reporting package. I use standardized formulas, separate inputs from calculations, apply exception checks, and perform reasonableness tests against prior periods and operational drivers. I preserve version control and document assumptions. Before distribution, I review key outputs independently or ask a colleague to challenge the logic and conclusions. Be sure to mention source validation, reconciliations, standardized definitions, checks, controlled formulas, version management, reasonableness testing, documentation, and independent review before communicating results. Question 16. Tell me about a time you influenced a non-finance stakeholder. A business partner initially viewed a forecast reduction as overly conservative. Rather than arguing from the spreadsheet, I walked through the volume assumptions, customer data, and recent trend, then asked which operational actions could change the outcome. We built upside and downside cases together and agreed on leading indicators to monitor. The final forecast was accepted, and the team gained a practical action plan. I learned that influence comes from credibility, curiosity, and shared ownership. In your answer, emphasize translating finance into business language, listening first, using evidence, handling disagreement constructively, offering practical options, and achieving a measurable or decision-based outcome. Question 17. How would you prioritize competing requests from marketing, sales, and supply chain? I would rank requests by decision deadline, financial impact, risk, dependency, and effort. A forecast needed for a major commercial decision would generally take priority over a lower-impact ad hoc analysis. I would clarify the required level of precision, communicate trade-offs early, and provide an interim answer when a full analysis is not immediately possible. I would also align priorities with my manager and maintain a visible task list so stakeholders understand timing and accountability. Focus on business impact, deadlines, decision dependency, materiality, risk, stakeholder communication, capacity planning, and maintaining accuracy instead of treating every request as equally urgent. Question 18. How would you assess a cost-saving initiative that could affect product quality? I would not evaluate the initiative solely on reported savings. I would quantify gross and operating savings, implementation costs, timing, service impacts, warranty or compliance exposure, and potential effects on consumer perception and market share. I would ask quality, R&D, supply chain, and brand teams to validate the operational risks and model downside scenarios. If savings are attractive but quality risk is material, I would recommend alternatives or a controlled pilot with clear success criteria. Make sure to cover financial savings, consumer and brand risk, quality standards, service levels, implementation costs, scenario analysis, reversibility, and cross-functional approval before recommending action. Question 19. What is the difference between a budget, a forecast, and a long-range plan? A budget is an approved financial target for a defined period and often serves as an accountability baseline. A forecast is the best current estimate of what will actually happen, so it should change when assumptions change. A long-range plan looks several years ahead and connects financial outcomes with strategy, capabilities, portfolio choices, and investment priorities. I would use the budget to measure execution, the forecast to manage near-term decisions, and the long-range plan to maintain strategic direction. While answering, distinguish purpose, timing, flexibility, detail, accountability, strategic horizon, and how the three tools work together in an FP&A operating rhythm. Question 20. Why should P&G hire you for this FP&A analyst role? P&G should hire me because I bring strong financial fundamentals, disciplined analysis, and the curiosity to understand what drives the business behind the numbers. I can build reliable models, investigate variances, communicate clearly with non-finance partners, and manage deadlines without sacrificing control. I also enjoy turning analysis into practical recommendations rather than stopping at reporting. P&G's scale and brand portfolio would challenge me to learn quickly, contribute thoughtfully, and develop into a trusted business partner. Be sure to mention analytical rigor, accounting or finance fundamentals, commercial curiosity, communication, ownership, teamwork, Excel and data skills, and specific enthusiasm for P&G's brands and development culture. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.